Hello, welcome back. In this series of videos, we are going to cover following topics: candlestick basics and candlestick patterns, where are the traps and breakouts, complete trading system, failed patterns and their case studies, then backtesting, pattern failure statistics and the advanced playbook, and last but not the least, psychology and execution discipline module. So these are the key areas which we are going to touch upon, and there are few more areas which we are going to talk about. So stay with us. There are certain free lessons and after that there are certain premium lessons. So free lessons are also going to help you, but I recommend that you go for the premium lessons as well, so that you have complete understanding from practical perspective. So now we are going to talk about candlestick mastery in this first video, which is a free video. So here we are going to talk about candlesticks, and candlesticks, as you are aware, that they don't predict price, but they reveal the interaction between buyers and sellers. We will just touch upon this again for your revision, but right now stay with that thought. And each candlestick is part of a broader context, so that context matters more instead of the pattern. So we will just represent a candlestick again. You can see on our chart. So here is a candlestick. We may pick up this one. So every trader looks at the candlestick charts, but very few understand what they represent. So what do they represent? We have already discussed that. Just have a thought around it. What do they represent? Basically, it is a record of behavior for a particular day. So suppose I am talking about a particular day, daily interval chart. So this is a record of behavior of buyers and sellers. So there are so many patterns. But what I have observed, people just memorize those patterns. Even if you don't memorize the patterns, if you just learn to look at the patterns so that you identify the pattern. So it does not matter what is the name of that pattern. If you look at the chart and you identify the pattern, that is sufficient. What's in the name? There is no use of name. So once you learn the patterns, you learn to identify. At that point of time, you need to have the name of the pattern so that you can understand which one is doji, which one is engulfing. But once your eyes get trained into it, then the naming will not matter. You will just see the chart, and after that you will make out whether this is a bullish pattern or whether this is a bearish pattern or consolidation pattern. So as you are aware, we have already discussed. So if we pick up any candle, what does it represent? It represents open, then it represents close, and it represents day high, and it represents day low. So red candle means open is higher and close is lower, and a green candle represents that price opened at this point, which is lower, and price closed at this point, which is higher. And what about these wicks? These are very important thing. If you study this particular candle, it has a lower wick, it does not have a upper wick. So what does that mean? So let's go step by step. Price opened up at this point, right? After that it went down, and after that there was a buying pressure, so that it reduced the loss, and finally this candle is closing here. But there was not too much confidence, otherwise it would have gone at the top. So people would have tried to go up, and after that it would have come down. But there was, although there was a buying, here is the buying, but still we cannot say, we cannot be very confident, because buying would have gone on to this level if it was a very strong buying. So it was just a value buying which happened at this point of time. Value buying means a stock corrected too much. So this corrected too much in a single day, and that's why some people who were thinking that this could be their level to purchase, so they jumped in and try to buy it. Next day also a follow-up buying came up. So what does a candle tells you? So every candle is answering one core question: who had the control during this period? So let's talk about this candle now. Again, in this candle, who had the control? It was sellers. Sellers were in control initially, but after that buyers came up and they were in control. And you see the beauty, the next day buyers continue to buy. So market opened at this point of time and it went up to this point of time. So now buyers were in control here, sellers were in control here. So this was overall a negative day, but at end of the day we can say buyers were in control. And that is important, because by end of the day, if buyers are in control, then in the next morning again you will expect that buyers will be in control. And that's exactly what happens here. Buyers were in control and market has moved up, opened here and closed here. So this is aggressive buying. This is a aggressive buying behavior here, and this is also an an aggressive buying behavior here which has continued. Now next day what happened? Market opened at this point of time, but because there was a momentum, we have seen from the previous 2 days there was a momentum this day and this day. So market, because of that momentum, went up, but after that price rejection came and there were sellers here who said that now it's enough. Market has quickly gained enough. Market has gained from this point to this point, after this point to this point. So market has already gained from this point to this point. You can see this much market has already gained. So it went further, but after that seller said this is enough, let's start selling here. And then on the next day you can see that selling momentum came in the market and it went down. So similar way this keeps on happening every minute, every 5 minutes, every hour, and every day and every week, based on which kind of chart you are looking for. So whatever the chart interval you are looking for, similar kind of behaviors will keep on happening. Now in this section we will talk about high utility candlestick chart. Now in this section we are going to look at the high utility candlestick types. So now we will look at 3 high utility candlestick types. So first of them is Doji. So Doji represents what? We will just see that. In fact, you will answer what does a Doji represent. So you can see what is happening here. Market is going up. We mentioned that market moves in swings. After that market has gone down. So there are sufficiently bigger bodies, bigger body candles. So there is some trend. Now after that momentum is losing, and after that we are looking at these kind of candles. Look at this candle. Here market has opened here and market has closed here at almost at the same point. Market has opened and after that it has went. Market has opened, it has gone down, then buyers have kicked in, it has gone up, then sellers have kicked in, and finally at the end of the day where the market opened, it is closing just around that point itself. So that simply means that there is an indecision in the market, and that's what we call as Doji pattern. D-O-G-I, Doji pattern. Now second kind of pattern is engulfing pattern. So now engulfing pattern is a big engulfing candle which engulfs the previous candle. So you see this is the previous candle, this green one is the previous candle, and now this candle is engulfing this candle. So it is completely occupying, and in fact it is having a larger size than this candle. So it is engulfing complete body of that and it is stretching below. So that means it's a very strong shift in the momentum. So it was the higher side momentum, now it is a downward momentum which has been shifted, and you can see market has gone further down. So this is called engulfing pattern. If an engulfing pattern is made on the upper side, engulfing green candle, that means market is going up. If it is happening on the lower side, then market is going down, at least for some time. Now there is another candle which we call as pin bar candle. So what happened? So this is called a pin bar candle. So it's like a pin and then there is a bar. So it is called a pin bar candle. What happens? It's called a rejection candle. Why rejection? So let's just understand. Market here is going up. So see, context matters. This is the context. Market is going up. After that market has opened here. It closed somewhere here last day and then it has opened here itself. So similar point where it closed, it has opened in the next day. But after that it has gone down. But the downside has been limited. So that means the downside has been rejected here. So what has happened? It has gone down, but the downside has been rejected because at this point of time a buying is coming. So now let's see the key concept of high utility candlestick type. So first high utility candlestick type is Doji candle. So what happens? A Doji candle is what? Let's see the context. This is the context that market is going down and after that market is going a little bit up. Then what happened? Then what actually happened? Market is closing at this point. Now next day market is opening at this point. Market tried to went up, but there was a selling pressure. Then market tried to go down, but there was a buying pressure. So at the end of the day market came where it was at the start of the day. So market is confused. It could not go up, could not go down. So that is called a Doji pattern. Now let's come to the second pattern. That's the engulfing pattern. So Doji pattern provide you indecision in the market. Shows that market is indecisive about its direction. Now let's talk about the engulfing pattern. So this is the engulfing pattern. What it is doing? It is engulfing previous candle. It is starting from where the previous candle is there, and after that it is engulfing it properly and even stretching beyond it. So this could be an engulfing pattern because it is stretching beyond the previous candle on both sides. And here this engulfing pattern is at the same level at this point of time, but stretching at least on the one side. So at least one side it is stretching, and on the one side it is, so the nature of engulfing pattern is at least on the one side side it is stretching beyond the previous candle, and on the other side either it is stretching or it is at the same level. The previous candle should be engulfed by the new candle. So this shows a shift in control. Shift in control, what do you mean by shift in control? Market is going up, it is a upside move, but now there is a red candle which is engulfing one. So it is a very strong candle and it completely shows the shift in momentum, and you can see market has not stopped here, it has gone further down. So that is the momentum. Now third pattern is spin pattern. So first we have covered doji pattern, that is indecision. Second is engulfing pattern which shows shift in control, and third is the rejection pattern which we call as pin bar. So let's see the context again. This is the context that market is going up. This is the context. Now at this point of time market has made a doji candle, market is little confused, and after that market opened at, see here market has closed at this point of time, market has closed at this point of time. Next day market opened at this point of time, but it has gone down. It tried to go down, but there was a rejection at the downside level. So that means people came up to buy the stock. So it has gone up and finally it has closed at this level. That means the downward pressure was rejected. Downward pressure, again I am again repeating, downward pressure was rejected. That means overall market sentiment can be considered as on the upside because downward pressure was rejected. So you can see slowly there were some further pin kind of candles, and after that market has gone up because this kind of rejection was happening from the market. We can read that. So these are not just three candle types, but these are the market behaviors, three different type of market behaviors, and you need to understand that psychology to be successful. And this bearish and this engulfing can be bearish, this engulfing can be bullish as well. So if you want to, so here if you look at this candle here, so this candle is engulfing this candle. So that means green candle is engulfing red candle. So that means it is looking to go up. So that means we have a upward momentum and it shows here as well. So that's how you read the candlesticks. Now what is the real edge? So the real edge is most of the less experienced traders focus on the patterns, but most of the experienced traders, now this is the real edge which I am going to talk about now. So this is where most traders go wrong. Less experienced traders focus on only on the patterns, but more experienced traders focus on the location. So when I say location, that means the context. We have seen in isolation, if you just pick up any candle, it is not going to tell you anything. But if you look at the context, so we knew the context here, market was going up, and after that we read this candle from that context. Suppose this candle was in some other context, market was going down and then it was created, then it would have meant something else. But it was going from this to this and then we saw this candle. That's why we interpreted it in a certain way. So that's why context matters. The location of those candles matters a lot. So that simply means, if I just want to summarize, a doji candle, so a doji candle here, because here is a consolidation kind of, a doji candle being created here is a different thing than a doji candle which is created here, which is on the uptrend. Similarly, an engulfing candle after the complete trend has been formed is different thing, and an engulfing candle when there is a momentum started, then at that point of time that engulfing candle is a different thing. So similarly, you need to see the context, going up, going down, or going sideways, then you need to read these candlesticks. Now for example, let's see this demonstration. Let's see what's happening in this demonstration. Here what do you see? Just have an observation and try to identify what is happening here. Let's identify first engulfing candle. So engulfing candle, so see there is one engulfing candle here which is largely engulfing this previous one, and then there is an engulfing candle here. So here it's just nearly engulfing, it is not 100% engulfing, but here it is completely engulfing candle. So what is happening? Market has gone this way and after that it has again gone down and after that it has gone up, but now there is a big engulfing candle. That means overall market sentiments are down, and at this point of time there is a very high selling pressure because a big engulfing negative candle or red candle has formed, and after that you can see market has crashed a lot. Now let's talk about some doji candles. Okay, so what happened here? You can see market is going down. Now market opened at this point of time and after that it has gone again down because there was a big momentum on the downside, but you clearly see that market has started to buy here, and then here itself the momentum on the positive side started and it continued till this point. So that's how a doji candle works. It is showing the rejection in the previous trend, and then we can say a pin bar as well. Now let's select one of the pin bars. Okay, now in the previous example I showed you a different context for the pin bar, but this example let me show different context. Market is going up. Now look at these two candles. What happened? Market has opened upside, but after that market has gone down also. But again there was a buying pressure here, and market actually closed nearly at this level, and this is a kind of pin bar which has been made, and this was a context on the upside and there is a lower wick on the downside. So logically you can see market was going up, and here the rejection happened at the lower levels so that we can buy more, and then we can see more buying pressure and market has further gone up. So this is the example how you should read the markets, read the candlesticks. Now the key actions for you: take any chart, and after that just identify. Now this is for your example so that these concepts are internalized for you. Take any chart, see the body size of that, see the wick length, and then the closing position. What does all of these things tell you? Just think about it. What do you understand by these three concepts? Body size, wick, and the closing point. And what do you understand by these 3 points? Body size, wick length, and the closing position. And once you have done that, then identify where is the doji candle which is showing indecision, then where is the pin bar which is showing rejection, and then where is the engulfing pattern or engulfing candle which is going to show the shift in control. So identify all of these aspects as well. So now after that just mark, are they occurring at support levels, are they occurring at resistance levels, or they are occurring in between some, or are they occurring, in between some trend which is going upside or downside, and what do you make out of that? Now the candles are most informative at decision points, not at the random moments. So what are the decision points? Your support levels, your resistance levels, and sometimes in between the trend also it's the decision points, whether the trend is going to go, whether the trend is going to continue, or whether trend is not going to continue. So that is also a decision point. So that point is very important for you as well. So now just keep in mind, pattern which we have discussed in isolation are not very powerful, but if you combine that with support and resistance levels, then it really become good, it really become more informative, and it will provide you more confidence. So experienced traders combine those patterns with the locations on the chart which matters. Now, in the next session, what we are going to do, we are going to connect candlesticks with market structure and understand how trends actually form.